Hi, welcome to my Fractal Range YouTube channel. My name is Vaidotas, co-founder of myfractalrange.com. And today I'm actually very excited because given me, I have a very interesting guest, Tom. Hi, Tom. Thanks for being here.
Hi, man. Thanks for having me.
So for those who don't know, Tom is quite active on Twitter, and looks like you, Tom, have some interesting process you have built your own tools and your model, which helps you in your trading and process in general. So
Yeah.
but of course we will talk about it later. So thanks again for being here, and just please introduce yourself.
Yeah, so my name is Tom. I post a lot on Twitter. I have a physics background. I have a degree in physics. I did that for a while. I did product development. Then I went to service technician, which is my current day job. So I trade on the side. I actually got into trading. It was like 4 years ago, to the same guys that you got introduced to, the ITPM.
Oh, nice.
Yeah. So I learned basically long short trading. Well, that didn't go really well for me. I think I blew up my first account in like a couple of months. After that, things got better. But it still wasn't my style. So I was always looking for the right style, for my trading style. And then through certain people, I got in touch with volatility ranges, and I went looking into that. I read Mandelbrot's book, which was eye-opening for me. And then it basically rolled in that way. And then I also saw Rafael, and he was making his own ranges on TradingView, which really triggered me. Like, wait a second. Of course, you can copy this and you can create your own version of it.
Okay, so let's stop a little. We will talk about it later. But so basically, your first introduction to markets and trading was through ITPM?
Yeah.
Oh, actually, you are lucky because, yeah, my story before I found a proper education and good materials, I started in Forex, and I have blown like multiple accounts over and over for years before I started.
Yeah, me too, man. Me too.
Oh, yeah. That's where everyone starts. Yeah.
Yeah, it was painful, but it had to happen. You learn so much from that.
Yeah.
But basically,
So,
go on.
So basically, what caught my interest when you said that you were still searching for the right trading style for you that suits you best. So you started with long short, and you said that it's not for you, or it was hard. So tell me more.
Yeah, for me it was long short was too time consuming.
Okay.
Because yeah, it was just basically that I could generate ideas, I could check them all in the watch list and update them weekly or daily, whatever. But then figuring out when to put on the trade was the really tough part for me. And that's basically, well, that's the reason I blew up my account back then. Yeah, so I had to find another way. I had to find another way to trade.
Yeah, exactly. That's my story is very similar as well, because yeah, in the beginning when I started this long short global macro stock trading, after finally I realized that I need to do things in a different way and stop day trading indices and Forex with huge leverage, which was basically not even trading, it was gambling. Yeah, but anyway, once I started applying these strategies in the market, yeah, I had the same issue that, yeah, I had a lot of ideas. I generated a lot of ideas, had all of them in Excel, but I never knew what to do once I'm already in a trade. So let's say I bought something or I sold something, and the biggest problem was what to do next.
Yeah. When do you add? I didn't know anything about market regimes, which was also a big thing back then, because that basically points the direction of the entire market, creates a headwind or a, how do you say, it works in your advantage or not. So when do you add? When do you cut your losses? When do you have all kinds of technical reasons for that, but you're never fully convinced, like, I know that this market regime is going to happen, and I'm buying the dip right now because I know that we're gonna go up, that high probability that we're gonna go up. Stuff like that, yeah, if that's not part of your trading, then it makes it really hard for me to trade that way.
Yeah, exactly.
I think you felt the same.
Absolutely. Yeah. First of all, position sizing. Actually, my biggest problem was not too big positions, but actually too small positions.
Really?
Yeah, just let's say I bought I opened a position in some stock, initial position,
Yeah.
and then it just took off, and basically I was late to the party. So that was, yeah, so position sizing and timing. So, okay, so volatility modeling. So, of course, we're all here interested in your story
Yeah, of
here.
course. Yeah,
So,
yeah.
how you started your interest in volatility modeling, fractal math, and some other exciting stuff. So how it all started?
Well, it started because of this firm, and that's basically what started my interest. And then I started reading about it, and well, because of my background in physics, you suddenly see it all around you in the world, and that really triggers me. Like, whoa, wait a second, this is not just fractal math, not just dominates markets. It also dominates nature. It is nature. And that's super interesting to me. So I went digging into that. Of course, I read Mandelbrot's book and did all kinds of research online. And the funny part is that all the stuff that I learned is available on the internet.
Yeah, exactly.
It's not magic.
Yeah, so first time I saw you on Twitter, and first time I noticed you was in the middle of last year, so in the middle of 2020, I believe I saw you commenting on some of Buddy Carter's tweets.
Buddy Carter,
yeah. Huge inspiration, huge inspiration.
Yeah, we used to email back and forth. He sent me some of his stuff. I sent him some of my stuff. And what was so interesting, because he had his own model, which he called
expected range.
Was expected range. Yeah, exactly. And he also had a volatility model, which he called storm something.
Storm tracker.
Yeah. And it actually produced the same signals my ranges produced. So that was already super interesting, that a guy, because I really look up to him, that a guy like him was emailing me about the stuff he was doing, and I was, that he took the time to converse with just some random person.
Yeah, he is
Twitter. Yeah, that was awesome, man. That's awesome.
Absolutely,
I still got all the emails.
He's very honest. Yeah, and it was a huge inspiration also. Yeah, I remember that at the time. Yeah, I already I had my model, and I was playing with for a few years with other volatility modeling techniques, not fractal related also, because I was trading options here. But what Buddy Carter showed to me and to everyone on Twitter, that actually you don't need to rely on very advanced stuff. That sometimes such simple stuff like ATR and others.
ATR, yeah.
Yeah.
When he showed me that he used ATR, I was like, Really? I thought it was some kind of concept that was too simple, but
yeah, exactly.
it's not.
Too simple, but
It's
but
not.
it's not.
Yeah.
Absolutely, it's not.
No.
Okay, yeah. So without giving away your secrets, just tell me and the viewers what you're doing. So basically, what are you modeling? What are you calculating? And then we will talk about how it helps you and how you use it.
Well, I actually already told everyone what I'm doing on Twitter. So everything I'm going to say now is nothing new. It's not a secret. So I am modeling volatility, the volatility of the volatility. And I calculate something called the Hurst exponent. And I do that by first calculating the fractal dimension. The Hurst exponent is 2 minus the fractal dimension. Then I get my exponent. And my exponent basically tells me whether a market is trending or consolidating. So I know you guys at my fractal range have ranges like upper bounds and lower bounds. I have them too, but they are not as good as yours. They are just indications. So I use it in a way to determine whether a trend is to start or to end, basically, or whether something is consolidating and about to explode higher or collapse, something like that.
Very interesting. Yeah, so that's why I'm very excited to have this conversation, because I use the Hurst exponent every day in my trading and process, and it's also part of the entire model, of course.
Yeah.
So now a very simple question, and I expect a very short reply. So tell everybody, is it possible to predict the future?
Yes.
Good.
Yes.
Yeah.
Well, yes, I would say yes. Otherwise, the model wouldn't work. With proper risk management, you can predict the future.
Yeah, I definitely agree. So, and there are multiple ways to calculate Hertz exponent. So you use the fractal dimension way. So yeah, okay. I use the full on rescaled range.
Oh, that one. Yeah. That's more computational.
Yeah, but yeah, so at first when I built it in Excel, it was crazy. Excel was freezing, and because but after that I built it in Python, and now it's quite fast. So
yeah.
Also for our viewers, there is a very old, I believe it's like 10-year-old video on YouTube from Parallax Research.
Yes.
Yeah, very good video. I recommend you all watch it. They have a so-called simplified Hurst also, actually. So I don't use it.
Local Hurst.
Yeah, local Hurst. I don't use it personally. I have tried it, yeah, but actually the advantage is that the calculation is quite easy. So
that's true. Yeah.
Yeah. So
I used the rescaled range to calculate Hurst. That's but I have to add one thing. My range is static, so it's not the lookback period is not shifting. Maybe for some viewers that will explain a lot. I just used 15 days as lookback.
Yeah, I have my periods are not static because I had some issues. Whenever I tried to use static, my ranges were not reacting quick enough.
Okay.
But okay, so enough geeky.
No, people will love this, man.
That's the goal, because actually what my partner at myfractalrange.com is doing, he's interviewing people who are using our tool, and you are not a subscriber, you have your own tool. So the main goal of this video, the main goal of this video is to show people that it's possible to build your own process. And basically what I want to touch now, basically, I want to talk with you about the importance actually of having your own process, importance of managing risk. So now let's move on and talk about the trading. So can you give us the explanation of your process in trading? So yeah, you have your model, so you run some calculations. What's next? Your trading approach and risk management approach, the most important.
Let's start at the beginning. Let's zoom out. I first start using Darius's model, so the grid model. That's my first starting point. For instance, if he is projecting deflation or Goldilocks, whatever, then that determines whatever I'm going to buy or sell. That's number one, because that's just the most likely outcome. So I start with that. After that, I filter down the stuff that's most likely to go up or down in that scenario. So deflation, I'm gonna buy gold or the dollar or short the euro or something like that. And because I don't have a lot of time to trade, because I have a main job, I only trade like 2 or 3 things, and I also hold them for a long period of time. So I might hold them for like 3 months or 6 months or even a year if that's working. Yeah, so I'd like to quote the investor Stanley Druckenmiller. He said, put all your eggs in one basket and watch the basket really closely. Well, that's basically what I'm doing, because it focuses my attention on my trades, and it keeps I always have this theory in my head on why the trades should work. And if I have only 2 or 3 trades on, then I can keep repeating that theory again and again and again, and looking for confirmation or disconfirmation. So it's and in that sense, that's also my risk management. And of course, I use stop loss. If I lose 10 or 20% of my account, I'm out, of course. But usually it's for me, it's a more mental process. So it's like a loop in my head that's checking if everything is still fine, and if that is so, I will keep the position.
Yeah, interesting. I'm sure that it's a lot easier to track 2 or 3 things instead of tracking like 30 or 20.
Yeah, yeah.
So how you enter and exit your positions? You average in, or you just buy and hold?
Yeah, usually I average in. For instance, when Darius is projecting a regime change, and my signal is consolidating. So for instance, on Bitcoin, there was a big consolidation signal when Darius was also projecting a few months of Goldilocks. So when that's happening at the same time, I'm like, wait a second, Bitcoin's consolidating and he is projecting Goldilocks. Those 2 things add up, and then I buy. It's really simple, basically. If I buy, let's say if I buy half of my desired position and it doesn't work right away, I'll wait. If my signal's still consolidating a week later, I buy some more, and well, then I ride it. And almost always after consolidation signal, you get a big spike up, as we saw in Bitcoin, or a massive drop. So you're either right or wrong. You're not somewhere in between. Usually.
Yeah, I understand. Yeah, so I want to touch on something you mentioned a few minutes earlier. that first you don't use your model to tell you what to buy and what to sell. You already know what to buy and what to sell based on macro.
Yes.
Or yeah, so that's a very important topic I want everyone to understand, because I personally, and we are on my fractal range sometimes receive emails or and questions like, guys, can you do a stock screener? Basically, can you tell what's at the top end of the channel, what's at the low end of the channel? Yeah, and I say that we will never do that, because these tools, and I'm not talking specifically about my fractal range or something, but all of these tools, all of these models are specifically for managing risk. In the first moment you start using this to tell you what to buy and what to sell, it's the start of a problem, because you must already know what you want to buy and what you want to sell based on something else. It can be macro, it can be fundamental research of a company or something like that. Yeah, so I really liked that you touched on that, and you were talking about 42 macro and the Darius research. Yeah, so you cannot, it's not a good idea to rely on one thing in your process. Yeah, so it's very good that you touched it, and I wanted to mention that as well.
Yeah, thanks. You have to basically stack the odds in your favor, as many of them as you can, and then trade it.
Yeah, because technically it's possible to build a thing that scans all the stocks in a specific exchange, for example, US stocks or something, and just to make a screener, but it would not be a good thing, and we will never do that. Okay, so you built everything in Excel, yeah?
I did, yeah.
Yeah, so it took a lot of patience, yeah.
Yeah, it took a lot of patience, copy pasting, stuff like that. Yeah, I know.
Yeah, I remember when I was still working with Excel. Yeah, I was very angry. I was very angry on that thing.
Yeah, it actually took me a couple of weeks to build it in Excel. It was a painful process, but it can be done. It can be done.
Okay, so and one of other things I wanted to touch on is the importance of sharing ideas. I was already talking about it on Twitter a couple of months later, but a couple of months earlier. But so tell me why you started sharing your model, or your work in general, sharing it on Twitter.
I think I did that. The main reason I started was because Buddy shared his work with me, and I was like, who is this? And he texted me. He sent me a message on Twitter. I wasn't the one asking him, be like, yo, can you share something? He was literally like, check this out. And I was like, whoa, holy shit. So that was basically, yeah, kind of my way of giving back, something like that. And also, yeah, I just enjoy sharing the stuff that took me so long and so much pain to build. I think that's fascinating, and if other people can learn from that, and also if you make your research and the stuff you're developing public, then everyone can look at it, and everyone can criticize it, and everyone can ask questions, and it also helps you develop your model.
Exactly.
So that's what happened, actually. And the funny thing is that it was you that made a comment on my model, and I was like, wait a second, I've been doing this wrong all the time, because I was looking at no, I think that goes into too much detail. No, let's not.
Yeah,
let's
okay.
not discuss it here.
Yeah,
Sorry, man.
Yeah. Oh no, I fully understand. So exactly, that's what I wanted to say. But at least for me, why I started that, because it helps you grow. Because
Yeah,
some people are on the internet and in the media. Basically, if they have something, they are kind of hiding it. They don't want others to know what you're doing, why you're doing, and how you're doing it. And in my opinion, it's exactly the opposite. Because if you start talking with like-minded people publicly on the internet, you will meet other people who are also interested in the same things that you're interested in, and that sharing will help you grow.
yeah, exactly. Yeah, absolutely. Yeah.
Exactly. So because also I'm very open. Of course, I will never like put a formula on Twitter or something like that. But I'm always open to talking about models, math, risk management, and everything in general, because you never know what you will learn from the person you're talking to.
Exactly. Yeah. Yeah.
Yeah, and also one related question. So, what do you think? What is missing in the financial media? So nowadays, what is missing for the average retail trader, retail investor? What is missing in the financial media and all the news outlets and the education and so on? What's the most important thing that's missing?
I think, and this may not be what most people think, that we said a lot about disrupting technology, and all these guys are just screaming and pumping stocks and doing stuff like that. That's all bullshit, and everyone knows this. What people should know, beginning traders, is that you can beat the market. And that's not something that's told in media, because the market is random, right?
Yeah.
Yeah. I think that's important, because that's what drove me, and that's probably what's going to drive a lot of other people. The insight that this whole thing is not random at times. Sometimes it is random.
Yeah, and actually, you mentioned Benoit Mandelbrot, and you said that you have read his book. So I believe you're talking about misbehavior of markets, right?
Yeah.
Yeah. So for those who are interested in fractal modeling, especially in the financial markets, I also want to recommend to everyone another writer. It's Edgar E. Peters. He has quite a few books on that topic, and one of those is Chaos and Order in the Capital Markets. It was his first book. So yeah, I also received a few questions about some reading recommendations. So once people are familiar with Mandelbrot's work, because there are a lot of papers, old papers from Mandelbrot with calculations and further explanations, but it's very heavy on math. I mean, you must understand math quite good to be able to understand what is in those scientific papers. So that's why Misbehavior of Markets is such a great book, because it's
true.
It's in plain English, basically quite advanced things explained in plain English, and almost without numbers at all, almost without formulas. So, yeah. So this is the first read, and then I still think that Peter's work is worth checking out for those who are interested. Yeah, so last thing I wanted to ask you. Yeah, I know that you're not a subscriber, but maybe you have some suggestions. So from the process and management perspective, what do you think would be the biggest missing feature in what we are doing, my fractal range and other similar services? What's missing and how can we improve?
For me, from what I'm seeing, and you guys actually posted that you're not going to publish this, so I always post my ranges with the upper and the lower bounds next to it in a time series, so you see the range with the price in the middle.
Yeah, historical data.
You guys told me or told someone else that you're not going to do that. I like that, but that's just my way of modeling things. I don't know, man. You guys are on a roll. You guys are doing great.
Thanks. Yeah, actually, yeah, we decided not to publish historical data, but yeah, we want our users and people in general to build a habit of tracking things manually. So I know quite a few users who have a historical time series of some ranges for months, so they just write it down every day or export it in Excel. Okay, so and also as an ITPM alumni, tell me, are you using such things like beta and correlation in your trading?
No,
nothing. Okay. Yeah.
But I know how to calculate it, but it just takes up too much time, and it's not in my.
Just one thing I forgot to touch, and I'm actually quite interested because I see people struggling with that, and I struggle with that. So position sizing, yeah. Can you still just talk about how you decide how much money to put into something?
I think that highly depends on your timeline. For me, when we are going to another regime and that is very probable, I go all in. So no leverage, but just 100% in that regime, and I just ride it. So is that a position? Yeah, that's basically max position size, I would say. I can share that between multiple assets that I like depending on my signal or not. So I usually have 3 or 4 assets. And when things are choppy, as of right now, it's everything is compressing and it's uncertain, then I'm less likely to invest a lot and more like maybe 50%, maybe less, maybe more if I think that another regime is coming. So it's intertwined with the projections for the next regime, my position sizing. But I think compared to what I hear on Twitter, I don't use basis points. I use like a lot, like 5%, 10%.
Yeah, so basically, like if you, for example, if you think that, well, not think, but yeah, if you have a high conviction that the market regime will be, for example, deflation, you just put a deflationary portfolio, 100% of your capital, and that's it, yeah?
No. Look, if we're projected deflation 6 months from now, then I'm not gonna buy like TLT or something. I'll
that's
wait.
Exactly what I wanted to.
I'll wait. I'll wait until I see at least one big compression signal, which means in my signaling model that the market's going to turn. So that one, actually, we ticked that one, the bottom of TLT, last May, I think it was, or even earlier. We ticked the bottom in that. That was one of those big signals that was like, wait, growth and inflation are going to slow somewhere in the future. We know that this is between now and like 3 months, and then came along a big signal. That's when I put in a lot of money. So is that 100%? Yeah, so usually it is. stuff like TLT, but not yeah, stuff like TLT. That's not that volatile. I put in 100%,
but not Bitcoin.
No, not Bitcoin, not
Yeah.
Bitcoin.
And not.
I wish I did though, but
Yeah.
that's not a story.
Okay, cool. And you don't use options, or you do?
I did, but I blew up my account, so I'm not gonna go back to using options.
Okay, got it. Yeah,
Yeah, that's the truth. Yeah, yeah, but that was before I had my my model, so my timing was terrible. That's my excuse. So yeah.
Yeah. So and maybe you want to say something to our viewers and subscribers, some advice on anything you want, risk management or life in general. Maybe you want to say something. You can say like something. Don't go all in on Bitcoin or something like that. Just
I would say this. I would say this, and never buy a bearish trend.
yeah.
That's it. Yeah, never do that.
Yeah, exactly.
If it's neutral, okay. If it's neutral and the regime is positive for that asset in the future, go ahead. But if it's bearish, don't buy it.
Yeah, exactly.
Whatever you're doing.
I'm signing on with those words. I mean, yeah, never buy a bearish trend. And let's, with this great advice, let's finish this talk. It was a pleasure. Thanks for agreeing to
yeah, it was
talk.
my pleasure.
Yeah, and follow Tom on Twitter. We will make sure that we put his Twitter handle in the description. So thanks again. Enjoy your evening and bye, everybody.
Thanks for having me.